Good morning, everybody. Welcome to another Market Report brought to you by Mike Bjork. Today is Monday, September 28th. We got a bit of economic news releases, so we're going to jump right into it. We're going to start off with the personal income for the month of August. So we had back in July an increase of 0.5%, which is great news. Forecast was supposed to go up 0.4% and came in a little bit under that, but personal income did go up at least 0.3%. So disappointing, but it's still good news. Consumer spending, we had 3.3% back in July. The forecast was supposed to continue and actually increase in the month of August, probably due to back to school and everything like that. So that was good news right there as well. Then we got core inflation. This is the PCE, personal consumption expenditure. We had a 0.1%. Basically went right across the forecast, given that forecast. So basically what this does is it brings the core inflation from 1.2 to 1.3%, which is good news because the Fed would like to keep it 2%, but still we're pretty far off from that number. We also got, last but not least, pending home sales. This is a bit disappointing. Back in July we had a 0.5% increase in pending home sales. In August, it actually pulled back to 1.4%, fell by 1.4%. A lot of this is being kind of attributed to talk about the Fed meetings for September, that the Fed would probably be raising rates. So maybe people are starting to sit on the standby as to see where the market will go when they're hearing rates going up. Now, something to keep in mind when you're hearing about the Fed raising rates, it doesn't necessarily mean your 30-year fixes are going to go up. What that means is that short-term rates, your Fed fund rates, or your stuff like your prime, and then even LIBOR, which will be the adjustables, those ones will be going up because those are short-term rates. That's what the Fed is tightening up. And they do that primarily to fight inflation, but because inflation is so low, it's basically slow us down. When the economy is growing too much, they need to slow things down by tightening up rates, because when the economy is taking out too much, usually we have higher inflation. They want to control inflation, but we don't have that problem at the moment in that regards. Now, because what 30-year fixes are built on is on mortgage-backed securities or bonds, and they have what they call their biggest fear is inflation, because when the Fed starts raising rates, many times those actually will go down for short term. Those will actually come downwards because it shows that the Fed is fighting rates. So there seems to be more investors will be buying mortgage-backed securities as a result, and long-term rates actually come downwards. So it's just kind of one of those things that people, I think, get confused on those. So that's why I want to do a short explanation of where interest rates and the Fed and everything, and how that's all affected. We'll go to the headline news here. Stock market's down quite a bit. Actually, the Dow is actually down more than 200 so far this morning. Part of it is on the global level. We got the China industrial profits dropped 8.8% from last year. It's basically telling investors that they're becoming more concerned because it seems like maybe China's slowing down more than what they expected, and it's kind of freaking them out a little bit. Also, on top of that, we had and with the big bag of economic news that we had here, on top of the Chinese. And then also Fed member, he's out of New York, basically made comments say that he believes that the Fed is still on track to raise rates in 2015. So we got two more meetings, one in October and one in December for the Fed to raise it. So they believe it will be most likely the December one if they do raise rates this year, primarily because there's an announcement scheduled afterwards, whereas October does not have an announcement scheduled afterwards. And they don't believe that the Fed would raise rates without having some type of announcement. Let's take a look here at the bond market. The bond is taken off. Yesterday we were struggling to keep above the 25-day moving average. We basically closed right at that level. Today we started a day above it, as you can see, kind of a star where we tested it, and then we tested the 200-day moving average. Right now we're kind of floating in between. So right now we're up about 25 basis points from where we left off on Friday, which translates to better pricing for interest rates today, which is good news for us. As you can see, especially over the last week, we've been really testing that 200-day moving average. If we can't break above this and stay above this, this becomes that much more difficult, and we probably won't break above it anytime soon. And so when you reach these levels and you're floating your interest rate, if you have interest rate you're floating, it's better to lock at this high point, because most likely you're not going to get anything better in the short term of this. All right, folks, I hope you guys have a wonderful day. Thanks so much for watching. We'll look forward to seeing you guys tomorrow. Take care.